Hey guys, welcome to a video on how Jesse Livermore made millions from tape reading. So this is going to be my own interpretation of Livermore's work and what he was trying to teach you about what is really going on from a supply and demand perspective, and these price movement patterns that are being repeated and make recurring patterns. What are those recurring patterns that you see in leading stocks at specific moments in time? And then I'm going to take you through my 3 favorite entries as well. 2 are variations of Livermore's Shakeout Plus 3, and then the other one is from tight consolidation pivotal point. So we'll be going through that. Got lots and lots of examples to be taking you through from 1926 all the way to the present day. Let you know that MarketSmith are today's video sponsor. They're running a free trial until the 24th of September. You don't need a credit card. You just need to enter your name and email address. You'll find a link to that in the comments section below this video. Now, with all of that being said, let's just start going through. We're going to start here with the price cycle because it's the context of where do you see things happening. But I'll just fast forward a couple of slides. You can see we're going to be going into the weeds. This is going to be a very thorough video focused on 3 specific setups, which again is my interpretation of the Livermore point, who had the greatest influence on my trading. So I'm sure many of you will be familiar with the price cycle, or you could call it stage analysis if you read Stan Weinstein's book or Mark Minervini's book, but it was Wyckoff who really came up with the initial concept of the price cycle. So there's phase 1 accumulation, there's phase 2 uptrend, phase 3 distributional top, and a phase 4 downtrend. So specifically, we're going to be looking at stocks during this presentation that are here in powerful phase 2 uptrends, and ideally our leadership stocks having a very high relative strength rating or hitting 52-week highs and or hitting 52-week highs on a relative strength line. Search my name on TradingView and you'll find this. It is free to use. So I'm not going to spend a lot of time on this slide, covered it in a lot of other recent videos, but we're looking here in the context of powerful phase 2 uptrends. So let's start going. So the main chart patterns that you're going to see, those repeatable patterns that occur, are going to be variations of flags, triangles, pennants, VCPs, cup and handles, wedges, which if you've read Minervini's books would be a VCP low mid pivot, or if you've read Darvis' book you could also see Darvis boxes, also known as a flat base. These are a couple of key quotes from Livermore which help sum up a lot of how I think about trading as well. So this is going to be really the only text heavy slide and then we're fully into it, but I just want to read these quotes to you to really set the stage, because it's very important. Remember this: when you are doing nothing, those speculators who feel they must trade day in and day out are laying the foundation for your next venture. You will reap the benefits from their mistakes. So what that means is understand your setups, understand how a stock moves into position where you want it to be. Okay, if it's not in position where you want it to be, there is nothing to do. There is nothing to do other than be patient and wait. So that's why you could see a developing flag, triangle, pennant, wedge, Darvis box, cup and handle, whatever it is, but it may not be in position where you want it. So let those other speculators, those investors, those traders lay the foundations being the foundations of your setup. Let the stock come to you, don't chase the stock. I define a continuation pivotal point as a consolidation where the stock pauses in its ascent, as a general sometimes pauses in a major assault to let his supply lines catch up to his troops and provide his men with a rest. So that period of rest, consolidation in the context of that powerful phase 2 uptrend. So these chart patterns and variations of chart patterns that you see are in the context of a powerful phase 2 uptrend. The prudent speculator, however, will carefully observe which way the stock will emerge from this consolidation and not anticipate. The pivotal point gives the only tip-off you need to trade and win. A speculator has to be patient because it takes time for a stock to run out its logical and natural course and a proper pivotal point. The key to my later theory of trading is to trade only on the pivotal point, and I'm going to show you pivotal point and 3 specific candlesticks and type of setup: slide, target, gap down, reverse bars, shakeout, demand tails, and trigger bars. All through time, people have basically acted and reacted the same way in the market as a result of greed, fear, ignorance, and hope. This is why numerical formations and patterns recur on a consistent or on a constant basis. This is why you just see these form time and time again, as you're going to see throughout this presentation. So these candlesticks, I'm not going to spend a lot of time on this slide, but the 3 most bullish candlesticks that you can see or a BU1, this one here, a BU2 and a BU3. That's just me labeling them for the purpose of this illustration, and we'll explain why in a couple of slides time. Also, you can have very bearish candlesticks. These would be some of the most bearish candlesticks that you can see, the BU1 to the BU4, the BU3, context of where you see it in the price cycle. So these are the candlesticks I want you to dial in your pattern recognition to, and these lay the foundations for the 3 setups that I'm going to be teaching you in this video. It is a variation of a hammer type candlestick that I call a shakeout demand tail, a belt hold bullish, which I also call a gap down reversal. What happens, it does context obviously if it gaps down or if it gaps up, but I'm looking specifically for when it gaps down and then reverses. And then tight candles that I also call trigger bars, but these are all in the context of the stock getting into the exact position that I want it to be in. So here we go. Let's start looking at a couple of things. So remember from that previous slide, okay, these shakeout demand tails and gap down reverse bars. This is the Dow Jones on a weekly chart back in 1926 to 1927. Gap down reverse bar, gap down reverse bar, shakeout demand tail, shakeout demand tail, shakeout demand tail. Now, just as we start on this slide here, some of you may be going, it's a VCP, isn't it? I can see a 1 contraction, 2 contraction, 3 contraction, 4 contraction. Yes, it's also an ascending triangle as well. You could just draw pretty much a straight line and just go 1, 2, 3, 4, building high lows. Now, what's important here is understanding already on this slide here that as you're looking for the lows of the bases, you are looking for evidence of demand. So a gap down reversal bar is evidence of demand. I will explain it in a couple of slides time as well. If you think about it, the prior weekly close was here, price gapped down, open here, and then pushed up. That is evidence of demand. If you think about a shakeout demand tail intra week, okay, price is opening here, it's going down during the week, and then it's pushing up and closing strong. Evidence of demand. So understand it is the large operators in the market that create the swing lows of bases. The 2 things large operators require above everything else is liquidity and perceived value. Liquidity and perceived value. So it's really constructive when you look at the lows of bases. If you see variations of gap down reversal bar, so price gaps down and then pushes up, evidence of demand. Demand is then winning over supply. And then over here as well, shakeout demand tail, little shakeout demand tail, shakeout demand tail. We'll bring the volume into it a little bit later on, but just to show you these type of candlesticks, how these bases form is absolutely timeless. This is nearly 100 years ago. So what I'm going to do is now start taking you through various different setups and how I'd be thinking about targeting them as well, and explaining the entry process as well. As I said, this video is going to be very thorough, like all of my videos. It ain't going to be fluffy, it's going to be in the weeds, and I will try and take you from the shallow end of the pool up to the deep end, but I got to make sure you can swim first and really try and explain these concepts. So this is Gatex in 1973. And I won't read all of these quotes out to you. Maybe I'll read a couple, but you guys can read this one I'm blabbering on as well. Let's just cover off the key moving averages, right? So I think all of the charts, other than when we get later on in the presentation, I think there's about 40 slides or so. Okay, on the daily charts, you're going to see the black line is a 10-day EMA. The blue line is a 21-day EMA. That is the most important moving average when you're looking at these slides, okay? 21-day EMA, this electric blue line, most important moving average. Pay close attention to that and what price does around that level. The purple is the 50-day simple moving average, grey is 100, and the red line is the 200. As I said a little bit earlier on, this relative strength line, free, search my name on TradingView, you will find it. I love stocks that are hitting 52-week highs. It's a very strong sign of strength. So let's take a look at this base here, okay? And I'm going to start with this gap down reversal bar. Now, remember what I said on the Dow Jones slide. Gap down reversal bars and shakeout demand tails are evidence that there is demand, and demand is winning over supply, and they're very constructive to see if they occur around the lows of the base. So this isn't textbook in terms of it could have gapped down a little bit more, but you can see the strength of the reversal here. Now, what's also important to look for on gap down reverse bars and shakeout demand tails is around the 21-day EMA as well, potentially the 50-day, potentially the 10-day as well. If it's a very quick stock, we'll come on to quickness a little bit later, is take a look at where the low is. So what I quite like to see on a gap down reverse bar and a shakeout demand tail is it undercuts the lows of the bases, or undercuts a vast majority of lows of bases and recent lows, maybe the last week or couple of weeks of trading, to shake out those weak hands. Because if you think about the potential traders, speculators trying to get involved in this stock here, where are they going to place their stop loss? I don't know, probably around the base low. Sounds highly logical, doesn't it? So the purpose of a gap down reversal bar and a shakeout demand tail is shake out those weak hands. knock out those stop losses, and then reverse. So it's very constructive, I think, to see a gap down reverse bar, a shakeout demand tail that undercuts base lows or undercuts recent lows. Could be a week, could be the last 2 weeks, could be undercutting a key moving average, so then a confluence there as well. So this is an important concept to be thinking about is, okay, it's a developing base, it's a strong stock, we can see that with the 52-week highs, and then we have a gap down reversal bar that undercuts base lows and reverses. This is evidence that I think large operators are in there supporting the stock and up to their usual games. Again, leading stocks and basically all stocks are trying to go higher with the fewest amount of people on board. Therefore, seeing gap down reversals, seeing shakeout demand tails is a very telltale sign for you to go, someone's in there playing some games, trying to shake out some weekends. Now let's go a step further as well and bring in the volume. So the level of volume that you see indicates how much supply there is. So if you think logically about this gap down reversal bar, the intention is to shake out base lows and try and knock out a lot of stop loss orders, okay? Take out all of those weak hands who have their stop loss orders placed here underneath the base lows, say underneath this 21-day EMA. So you see this gap down reversal bar, what do you notice about the volume? Well, it's below this black line here. And what is this black line? This black line is on the daily chart. It's the 30-day average volume. So I just keep it consistent, 30 bar on whatever chart that I'm looking at. It doesn't matter if you want to use 27.5 days, 31 days, it doesn't matter, okay? 30 days works very, very well, 30 bars for what I'm trying to accomplish with this. So I'm looking at this here. Well, I wasn't looking at it in 1973, but as I then analyze this base and see how did the stock actually absorb supply? How did the strong hands move in? How did they accumulate shares? How did they shake out the weak hands? Like the stock, the chart is trying to tell you a story. Your job is to read the story of what is going on here from a supply and demand perspective. So this gap down reverse bar takes out base lows underneath the 21, gap down, reverse, strong close, and there's not much volume. What does that tell me about the amount of supply at these levels? There's not much supply. There's not much selling. You can visually see it in the volume. If you think about the context of the bar, think about the context of the base, think about the context of the volume, think about the context of the relative strength line, it's a leading stock, and then you get this bar here. This is really, really good bar. Now on the next slide, I'm going to teach you about how I set up entry orders around this. 2 bars later, we get a nice little shakeout demand tail underneath the 10 and 21. So closes on the high of the bar, but a little shakeout demand tail, and then over here, we get what I call a trigger bar. So these are going to be the 3 bars that I'm going to be teaching you about. Gap down reverse bars, shakeout demand tails. Now, these aren't exactly Livermore shakeout +3, but they act as shakeout type bars, certainly if they undercut the lows of the base and recover. I don't trade the Livermore shakeout +3, but I trade gap down reverse bars and shakeout demand tails when they happen in specific points on the chart. And then trigger bars as well. This is kind of the last indication that there's now very little supply coming to the market and where the risk versus reward can really make sense. This one here, I'll just touch upon this, because you see this breakout here and then you get this supply shoot. Now a supply shoot, I know I'm covering a lot of concepts and it's coming at you like a fire hose. Like all my videos, I would suggest watch it a couple of times because I have dyslexia, I have ADHD, I talk ridiculously fast. This brain here just goes at 8,000,000 miles an hour and it probably comes across in these videos, but I can't go slow. So this one here, supply shoot, right? Price is trying to go and then sellers push it back down, but it's very V-shaped in nature. So this is called running up. See how it's V-shaped? This is the left side of the V, then the right side of the V here, V-shaped. I avoid V-shaped breakouts. Why? Because you're asking the stock not only to absorb the overhead supply in the base, which is giving you no indication that it's done, unlike this trigger bar over here, really tight bar, low volume, there's no supply, there's no more selling coming to the market. It's really good to see. And then people that were potentially buying the dip down here, gap down reverse bar, shake out demand tails, lowering the base, go, oh, it's running into the highs of the base, I'm going to sell. It all becomes a self-fulfilling prophecy quite darn quickly. But now let's just talk about this a little bit, okay? Because risk management. So I'm only going to do this with a single slide rather than do it for every slide. Otherwise, you'll be here all day and I'll be here filming it all day, okay? But obviously, gap down reverse bars, shakeout demand tails, and trigger bars have different risks. Trigger bars are often much tighter. Trigger bars are much tighter than gap down reverse bars and shakeout demand tails invariably. So the risk can be tighter on those. However, a gap down reverse bar and shakeout demand tail can still be an effective entry method in my view, but it depends on the risk. So we're going to talk about the risk a little bit and I'll just read this out to you. So this is a quote by Livermore. The 10% loss rule became my most important, not post, I should say, most important rule for managing money. Remember, a speculator must set a firm stop before making a trade and must never sustain a loss of more than 10% investor capital. It's very, very, very rare that I will have initial stop loss anywhere near 10%. A good initial risk metric is thinking about the initial stop loss versus the stock's 20-day average daily range percentage, ADR percentage, which is this here, Ideally, initial risk is half to 2/3 versus the 20-day ADR percentage, and that there is a good risk metric. So we then have to be thinking, okay, this stock here is a little bit of a slow one. Okay, the ADR is about 1.3%, 1.28%, 1.25% at these specific moments in time. Now, to put that into context, the triple Q's ADR percentage ebbs and flows around 1.5%, 1.3, 1.5%. I ideally like to look for stocks with an ADR of 0.5 or 1.5 to 2 times the triple Q's ADR. Why? Because if the triple Q's goes up 10%, I want to be in a stock that can go up more than the triple Q's if you apply some logic and common sense to that. So I want to be in the quicker stocks in the market, not the slower ones. But for a first illustration here of a stock where it happened, how many years ago? 50 odd years ago, just to show it's absolutely timeless, this. Okay, so a gap down reverse bar. This is obviously the gap down reverse bar here, check out demand tail here, trigger bar here, but I want to show you how I think about planning the trade out. So with a gap down reverse bar, I use, and check out demand tails, trigger bars, I invariably use what's called a buy stop limit order with a stop loss attached. So how does that look? Well, the buy stop here would be through the high of the gap down reversal bar, 11.69. Now the limit, I usually go 0.5% above the high of that bar. That means I don't want to get filled higher than 0.5% above the high of that bar. Why do I want to do that? Because I want to know exactly what is the maximum I'm willing to pay for any shares. Why is that important? Because now I know what is my maximum risk, and my risk, my stop loss invariably goes a cent below the low of either the gap down reverse bar, the shakeout demand tail, or the trigger bar. Maybe if there's a key moving average, it'll go a little bit lower, so I can ensure it's below that. Maybe there's a really round number and I'll get it just below that, but invariably I'm targeting it through the high and up to 0.5% with the limit, and then underneath the low of that bar as well by around about 1% or so, planning it out all in advance. So the ADR percentage, when I look here at the gap down reverse bar, and don't worry, I'll come on to these purple and green lines in a minute. So the gap down reversal bar, the initial risk on the trade, assuming perfect execution getting filled at 11.69 and a stop loss a cent below at 11.41, would be 2.4%. Okay, versus the ADR percentage of 1.28%, it's not ideal. In an ideal world, you want to be half to 2/3 the ADR percentage of 20-day ADR and keep the risk nice and tight. So this is maybe one you pass on. Maybe you really like the stock, and what you can then do is build into the position and go, well, I'm not going to go in with a full position here. I'll take half a position here. If it then sets up another entry setup, shakeout demand tail, trigger bar, I could then add to my position as well, but only adding higher up. As Livermore said, losers average losers. So this is how you can see a good setup and go, the risk doesn't make sense. Now let me talk about the shakeout demand tail, and we'll bring in these purple and green lines as well. So the shakeout demand tail, same process, target through the high, stop underneath the low. I haven't put the limit order in here to show in terms of being 0.5% above the high. This bar I think will get very confusing very quick. It's probably already quite confusing as well, isn't it? So here, 11.75, stop loss cent below at 11.62. That's also underneath the 10 and the 21. Nice. Now 1.11% versus the ADR of 1.25%. Okay, it's not half to 2/3, but it's underneath the ADR percentage. That is a pretty good metric there. That's not bad. It's looking like an interesting setup. When I'm then looking here as well, the purple line is 1 times the initial stop loss, and the green line is 2 times the initial stop loss. Now I've covered risk mitigation and free rolling levels in other videos, so you can go and check those out on the channel. But then what I'm looking at here is going, okay, where am I looking to free roll? Because for me, I think there's 4 main elements of a trade. Number 1, you got to identify it. Number 2, you got to control the risk. Number 3, you got to mitigate the risk. And number 4, you got to optimize the profits. So this here, these purple and green lines are all about thinking about risk mitigation. So these are levels that I'm thinking about selling. Okay, at the purple line 11.88, I could be selling half of my position to free roll the trade, assuming kind of perfect execution, initial stop loss there. The green line is where I could be selling 1/3 of the position at 2 times the stop loss. That's how the math works, to free roll here. And I could be looking and going, well, I could be taking off 1/3 there at 12.02. I probably don't want to be selling at 12.02 because that's just above a round number. So maybe I want to do 11.99 and then just push up my stop loss a couple of cents. And then I'm also free rolling into base highs as well. Remember what we saw on the prior chart with running up there here, this supply shoot here, running into base highs and then faltering. I want to be aware of that. Where am I expecting supply to come in if I'm targeting these lower pivots in the base? Now you get the trigger bar over here. Now the trigger bar through the high, stop underneath the low, is 0.58%. Now I think this will be split adjusted several times as well, but 0.58%. Now we're really talking, that's half the ADR percentage of 1.3. So you see what I mean about thinking about half, 2/3 versus the ADR. But these shakeout demand tails and gap down reverse bars oftentimes will be actually around the ADR percentage, if not a little bit more. So it's then all about thinking about the quality of the setup, thinking about the level of risk that you're taking as well, thinking about risk mitigation. If it's a much lower entry in the base, it's then thinking about, okay, if I see another setup higher in the base, can I pyramid in and really concentrate into that position as well? But that there is about thinking about the risk of gap down reverse bars, shakeout demand tails and trigger bars, and then linking it back to a metric and an anchor point being the ADR percentage, and really thinking about the level of risk that you're thinking of taking, thinking about the free rolling targets as well. So let's keep going. So already you're probably thinking about, well, how do I actually scan for these type of stocks like this? Now I'll show you how to do this at the end of the video, but I'll just put one in here as well. We have a free plan available on my site. We have paid plans available on my site as well. I think these ones here, these preset scans, they're all available in the free plan at this moment in time. So you can go here. Okay, we've got continuation based screens. I would go test out those for regions that you're interested in, so whether it be India, whether it be Canada, whether it be Australia. And I know I normally save the screening till the end, but I just want to explain to you that you don't need to make this so complicated. Okay, you just don't need to make it so complicated. This doesn't need to be complicated. So this is going to be criteria guidelines for screen. Okay, there's no magic pill to only find perfect setups. If you think you can create screen with perfect criteria, perfect metrics, and there's just going to be a perfect high tight flag in front of you, it doesn't work like that. You must actually do a bit of work, look at some charts. So criteria guidelines, in essence, to find these kind of setups that you're going to be seeing, this is what you want to be screening for as the criteria guidelines. Price above the 50-day moving average, price above the 200-day moving average, to better ensure that the stock is in the context of that phase 2 uptrend. 50-day average volume, you want that to be greater than 50 to 100k, depends on liquidity parameters you want to be applying to that. Closing price, I would say you want it to be above $1, potentially above $10 as well. Get out some of that junk. Bonus, filter the above results by highest 3-month relative strength first. So what I like to do in my own screening to find these kind of setups like this and these kind of stocks like this is have the criteria that is not very strict. It's not very onerous. I'm looking for stocks in the context of powerful phase 2 uptrends, but then I'm filtering via relative strength rankings, and I like using the 3-month relative strength ranking. So you can see here I've actually applied it to one of the preset screens here. So relative strength ranking on a 3-month basis greater than 75. So what this is going to do is it's going to cast a wide net, and then I'm filtering via relative strength. So I want to have the highest 3-month relative strength stocks at the top of the list first. Why? Because they are the strongest stocks in the market. And as Livermore said here, I also believe in trading the market leader. Go with the most powerful stock in the group. Don't look for the bargain, the weak sister. Go with the leader, the anchor, the strongest stock in the group. The strongest stock in the group will have the highest relative strength. So that's why I like looking for relative strength. So head over to my website. There's a free plan, there's paid plans as well if you want to go and test this out, and I'll do a little bit of screening at the end of this video for you as well. So let's go for a couple of others, right? This one here is Foot Locker. Now there's numerous examples here of a gap down reverse bar off the 21-day EMA. As I said, pay very close attention to the 21-day EMA, and then if you're seeing gap down reverse bar, shakeout demand tails around that. For bigger bases, like you can see with Foot Locker here in 1975, what chart pattern is it? Well, it's a bit of volatility contraction pattern, you could say. 1 contraction, 2 contraction, tight in here. The volume generally dries up as well. The RS line holds up pretty well, albeit it would be even better if there's 52-week highs in this region. And then look at this shakeout demand tail. So why is it important? Why is the 21-day EMA important? Why is the 50-day moving average important as well? Because it's an area, a region where you would like to see large operators stepping up and supporting the stock. How do you know if they're stepping up and supporting the stock? You guessed it, gap down reverse bars, shakeout demand tails, relative strength holding up. What is the stock doing versus its group, versus its brother sister stocks, versus the indexes as well? Is it showing relative strength? So you see this gap down reverse bar, this shakeout demand tail off of the 50. Remember what I said on GATX about undercutting recent lows. Could undercut base lows, but undercutting recent lows as well. So you can see the low here, it actually takes out the last, 3-4 weeks of trading in March of 1975. So imagine these traders that were trying to get positioned in here, or maybe someone that bought it in here and then saw, oh, it's consolidating, I'm going to place my stop loss just here. Or these traders trying to get in here, placing their stop losses here. What does this shakeout demand tail do? Get out all of those weak hands, knock out all of those stop losses. And what do you notice about the volume? There's not much volume. What does that tell you about supply? There's not too much supply that's coming to the market, and you're seeing supportive action off What moving average? The 50-day moving average. Constructive, right? So shakeout demand tail, and then in here you start getting your trigger bars. So again, here, gap down reverse bar, shakeout demand tail, trigger bar. And remember what I was saying about thinking about the risk. So I haven't got the ADR set on these stocks, but remember, I'm only going to do it the once, what I did with GATX in terms of think about how I would plan the trade out. Okay, through the high, stop underneath the low. What is the initial risk relative to, say, the ADR percentage as well? Do I think it's a good quality setup too? Now, the continuation pivotal point doesn't always form at base highs. So you see here, with Foot Locker, now this will be split adjusted 101 times, the pivot is actually setting around $3.50. Why? Because the pivotal point is where price action gets really, really tight, and ideally you'd like to see the volume dry up as well, because this is an indication that there's very little supply coming to the market. If I go forward one, HL, this is a gold stock. So you see again how you're getting this tightness in price here, and look how the volume dries up. This is absolute textbook trigger bar, inside bar there, sitting around the 1021 plus the 50 in there after the shakeout demand tail off the 50-day, undercuts base lows. I mean, just look at this. Look at that. Look at that. It is the same thing. Like from a supply and demand perspective, it's recurring patterns. This behavior in the market that you see, it just repeats time and time again. But going back to my other thought here about this tightness in price, the continuation pivotal point forms where you get tightness in price, low volume. It's the market indicating there's very little supply now coming to the market. There's very little selling pressure. So this here, through the continuation pivotal point, this is where price should move really quickly. So again, then thinking about trigger bars or shakeout demand tails in these vicinities, well, tight stop loss here, and the expectation is price should just power through these levels here and then go and ride the intermediate term trend. So this is what you'll commonly see leading stocks do. They will tighten up before they come out of these bases. KEX in 1980. Now shakeout demand tail off the 21 and see how it undercuts the last week and a half, 2 weeks of price action here. So shakeout demand tail onto the 21 really important. Why? Because as we're going along, these are leading stocks that are in this presentation. I don't care how a $50 million biotech stock in terms of its market cap moves. I don't care. It's going to be volatile. It's going to be erratic. What I want to do and continue deepening my knowledge is how do leading stocks throughout history move? How do they move? What do they do? What do they do and where do they do it? Are there trades to be had? How can I then think about mitigating the risk? How can I think about optimizing the profits? So as we're going through, pay attention to the relative strength line. Oftentimes you will see these 52-week highs pre-base, so in the rally pre-base, in the base as well, and then look, where is the stock finding supportive action? Oh, that's interesting. It holds this blue line. It holds the 21. That's interesting. It does it again. That's interesting. To the penny, it bounces off the 21-day EMA here with a shakeout demand tail and low volume. That's interesting, isn't it? So again, 21-day EMA, that area, that vicinity, that region is where oftentimes you'll see leading stocks get supported. And if they don't get supported, it doesn't matter. Like it doesn't, there's nothing to cry about. But if a leading stock of today then acts like this, I then have this in my head of tens of thousands of stocks in the model book of just going, right, okay, I saw that happen with KEX in 1980. I saw it happen back in the 1950s, in the 1960s, 70s. Interesting. Is there a setup to be had there? So shakeout demand tails undercutting recent lows off the 21 and low volume says there ain't much supply, there ain't much selling coming to the market. CGC, so this one here, this is what I'm talking about in terms of pre-base action. Look at the volume coming through. This is called bullish synchronicity as well. Price opens on the low, widespread candlestick on a relative basis, powering it up. Someone for some reason has a lot of interest in acquiring shares here. Don't know what the reason is. I can't ask them. I can't go back to 1981, but visually I can see the demand. Do you visually see the demand? Look at this bar. Look at this bar. Look at the volume coming through. Fantastic. Now this here, supply shoot on high relative volume, this is actually a Wyckoff concept of diminishing upwards result. So result is diminishing to the upside and effort is still high. This bar, there's actually hidden supply behind this bar, and then the stock starts basing into this flag. And what do you notice here? Oh, onto that blue line, the 21-day EMA, shakeout demand tail, and then it's also the context of the bar. Where's the close of that bar? Do you see? The close is then back on the high of the bar. So shake out the weak lands, take out these stop losses, undercuts the vast majority of base lows and the last 2.5, 3 weeks of action as well. Undercut those, close on the high, indication of strength, and then trigger bar, and then it rips. Interesting stuff, right? SMP. So here, what marks the low of the base? What bar marks the low of this base? a big old shakeout demand tail. So this is what chart pattern? It's a cup with a low handle or a mid handle. So here's the cup, here's the handle. After this shakeout, look at the demand visually stepping in, and then trigger bar, trigger bar, trigger bar. Look how the volume dries up. So tightness in price, low relative volume tells you what about supply? There's hardly any selling pressure coming to the market. Now we'll quickly touch upon some optimizing profits. Remember, identify, control, mitigate, optimize. So for me, I like riding the 10-day EMA being this black line and the 21-day EMA. Sometimes I'll bring in the 50-day moving average as well. I covered that, I think, in the most recent video before this one as well. The context matters a lot. Are you just coming out of a phase 1 base? Are you late in a phase 2 uptrend? All of those things are important considerations. But I will look to ride the 10 and the 21, and if I think price starts getting extended from the 10-day, choke off some of the position by adjusting my stop loss up invariably to the lower the bar and going lower the bar on all or part of my position. That's on a case by case basis. IGT, so see here, shakeout demand tail, bounces just about off the 50, holds just above it, but look where the low of this shakeout demand tail is. Undercuts the vast majority of base lows. These bars around lows of bases are so good to see. And then where are you looking for a leading stock to get supportive action? Around the 50-day moving average. How do you know it's a leading stock? Did you see the relative strength line, all the 52-week highs? So here, gap down reverse bar onto the 50, shakeout demand tail onto the 50. I don't know who's supporting it, but someone is supporting it with a lot of cash. Good to see. And then tight. Look how the volume dries out. And then what did I say on the last slide? About riding the 10, about riding the 21. So tight initial stops, thinking about it in terms of the initial stops versus the ADR. Half to 2/3 ideally. Gap down reverse bar, shakeout demand tails. Maybe around the ADR percentage, maybe a percentage point or so above. So you really then got to be thinking about it, the quality of the setup. Does the risk make sense? Is it a high enough quality setup to be taking this amount of risk? Do I potentially want to wait for a trigger bar? Now obviously if you're trading through the highs of trigger bars, you're more likely to get stopped out. Why? Because the closer your stop loss is to the price action, the greater chance you have of getting stopped out. The wider your stop loss from the price action, the less chance you have of getting stopped out. If you have 50% stop losses on every trade that you go in, you're not going to get stopped out very often, but you're going to tie your capital up for long periods of time. And when you do get stopped out, you're going to have very big losses. So that is what I think is the advantage of gap down reverse bars, shakeout demand tails, trigger bars, your hypothesis for being in the trade. So this shakeout demand tail here, imagine if you bought this shakeout demand tail here, okay? So you target it through the high of this bar, it then goes 2 days later, you then get this tight inside bar low volume, so very much apply. But your hypothesis for being in the trade, or your reason for getting out of the trade, where is your line in the sand? Your line in the sand is, well, this shakeout demand tail should mark the low of the base. If it goes below the low of the shakeout demand tail, I'm out. Like, my whole reason for being in the trade is price is trading above that. If it goes below that, I'm out. This was supposed to be a shakeout demand tail underneath the key moving average, set one of the lows of the base. It shouldn't go below that. Same with a trigger bar. The expectation is price should power out through this because the market's indicating to me, well, it's tight price action, setting up around key moving averages, good base duration. What chart pattern do you see here? 1 contraction, 2 contraction, 3 contraction, 4 contraction. Look how the volume dries up. Leader before the base, RS holds up pretty well in the base as well. It's not bad, but the expectation here is price should just power out. So if you think about this here, okay, it's targeting it through there, and the stop loss is placed just underneath the low of that trigger bar. Maybe you want to do it underneath the low of the prior day as well, a little bit wider, so just underneath this pivot here. Again, things that you have to be thinking about. Trading is a thinking person's game. Here, eBay, this is back in 1990, okay? Shakeout demand tail off what moving average? 21 day. Leader, you can see the 52-week highs, right? So as eBay starts basing here, bit of a VCP, right? You have 1 contraction, 2 contraction, 3 contraction. Look at the tightness and the clustering of the 10, 21, and 50 SMA like that. You then have a shakeout demand tail, and then you have a trigger bar. But what marks the low of this swing low in here and this swing low in here? What bars mark the low? Gap down reverse bar, shakeout demand tail. Do you remember the chart of the Dow Jones about half an hour ago now of the Dow Jones in 1926 and 1927? What marked the lows? What bar marked the lows? Gap down reverse bar, shakeout demand tails. The presence of demand and the presence of supply is timeless. It's not going away. The presence of demand is timeless. So if you understand that concept, you know what you're looking for on the chart. Presence of demand. And even better, if at the lows of bases you see, wow, gap down reverse bar, wow, shakeout demand tail, someone somewhere for some reason is supporting the stock. Now this gap down reverse bar is going to be very wide. The risk ain't going to make sense. maybe it could make sense on the shakeout demand tail, but certainly over here, when price action starts getting really tight, the risk is going to make sense on this shakeout demand tail. The risk is going to make sense on this trigger bar relative to the ADR percentage as well. Now, I don't like having initial stops greater than 5% either. I'd say my average stop is somewhere between 2% and 3%. Okay, anything over 5%, I really got to justify it. Like, really got to justify it. Let's keep going. BHC. So see how you get the shakeout demand tail off of what moving average? Off of the 21-day EMA, and see how it undercuts the base lows. Not a bad bar, right? And then it turns out to be a cup and handle type pattern. So here's the cup, here's the handle, slopes down in the handle, that's really good, and there's a trigger bar. So again, if you're then looking at this chart and then you're looking at, wow, that went quite a long way for closing below the 10-day or the 21-day, and look how tight the initial stop loss was. Imagine if you got it here as well. So again, I like to look for various different setups and entries in basis, gap down reverse bar, shake out demand tails, trigger bars, right? Around specific areas as well, as I'm teaching you in this video. So for me, if I didn't trade in 1999, so what do I know? Ignore me. But here, right? Gap down reverse or shake out demand tail off the 21, there's a good entry. And then if it sets up a trigger bar over here or another shake out demand tail and it's higher up and I haven't been stopped out, I could add to my position and then raise my stop loss on the initial position as well. Maybe I've already free rolled the initial position into this pop as well. So then I'm trying to build my concentration, build my size without taking any more risk, and I even mitigate the risk. Now we're starting to talk a little bit, aren't we? CPE, shake out demand tail off what moving average? 21-day EMA, undercuts a lot of the base lows, not much volume, tells you what about supply, there's not much selling pressure. Then here's a subtlety as well. You ready for the subtlety? Do you see where it closes? Now you may say, well, it closed at about, oh, what's that? I'm looking over here, about $19.50, Jack. That's not what I mean. Where does it close in relation to the bar? On the high of the bar. So if you get shakeout demand tails and gap down reverse bars that close on the high of the bar, that's a better indication of strength, a better indication of the presence of demand. And then trigger bar. Nice. Bitcoin. Let's do a couple of cryptos, right? This is Bitcoin when Bitcoin was $7. $7 in 2012. Okay, it's absolute time. Remember what I was saying. The presence of demand is timeless. The presence of demand is timeless. The way smart operators, the way supply and demand interact with each other is timeless. Timeless. And it doesn't matter whether it is Bitcoin at $7 in 2012, the Dow Jones weekly chart in 1926. The presence of demand and how it visually representates itself, did I say the right word? I think I did, is timeless. So Bitcoin, in the context of an uptrend at $6, and it bounces off a nice round number of $6, market likes to move to round numbers, undercuts the base lows, shake out underneath the 21, and then over here as well, another shake out demand tail off the 21-day EMA. Panel, UK stock, oil and gas stock, I believe, gap down reversal bar onto the 21-day EMA. Trigger bar, trigger bar, trigger bar. So this is where gap down reverse bars, trigger bars, shake out demand tails can help me pyramid into what I think are leading stocks. How do you know it's a leading stock? Well, high relative strength ranking, 52-week highs on the relative strength line. Really good to see. And then look at the explosive move the stock has made. It's already made a double just on this chart here. Okay, look at the trigger bar. This is about $29. Here it's up $72. Not a single close below the 10-day EMA. Get the big ones right. Sound Energy, another UK oil and gas stock, really powerful uptrend here. Look at the bullish synchronicity. So the widespread relative candlesticks opening near the low, closing strong. Look at the volume above the 30-bar average, confirming the move. Look at the 52-week highs. Shake out demand tail. Shake out demand tail off of what moving average? 21-day EMA. Trigger bar, trigger bar. Timeless. ETH, 2017, 2018. What do we notice? Well, where are you seeing the shakeouts? Where are you seeing the supportive action? Wow, this blue line looks interesting, doesn't it? Again, shake out, shake out, shake out, shake out, trigger bar, go. AMD 2019. This is a absolute textbook gap down reverse bar. So I'd say it's more common to see shake out demand tails than gap down reverse bars around 21-day EMAs, but gap down reverse bars, very effective. Again, what is it telling you from a supply and demand perspective? So here we have AMD. Is it a leading stock during the context of this uptrend here? Well, take a look at the relative strength line. It's turning up, trending up, and yet blue dots, 52-week highs, really good. So it pulls back down to the 21-day EMA. Now, are we expecting someone somewhere, some large operator, to step up and support the stock? Well, they may do, they may not do. But if they do, this is where we have a Bayesian mentality. So Bayesian mentality means you constantly update your decision-making process as new information becomes available. You adapt. What did Charles Darwin say? It's not the strongest species that survives, but it's the one that can adapt to change the quickest. Adapt to change. Have a Bayesian mentality. So the prior close is here. Price gaps down, opens near the low of the bar, undercuts to 21, reverses. 21-day EMA, leading stock basing is a stock, an area, a vicinity of price around the 21. You'd expect to see large operators step up and support the stock. If they don't, they don't. That's absolutely fine. There's always another bus. There's always another stock. But if they do step up and support the stock, okay, gap down reverse bar, 21-day EMA. Does the risk make sense? Got to then be planning the trade out, thinking about it. And then you get this really nice tight trigger bar. So trigger bars are basically really tight bars. Often they're inside bars like this bar and low relative volume sitting on at least the 10-day EMA, but potentially the 21 is there as well. If it's a bigger base, maybe you get a clustering of the 10, 21 and 50 like that as well. And then it's about riding the intermediate term trend. As Livermore said, traders that can both buy right and sit tight, very, very, very uncommon. I don't think he said very that much, but you understand the point, right? Peloton 2020. Shakeout demand tail. So Peloton, leading stock, remember, stay at home. Everyone was looking, not everyone, but people then looking to, I can't go to the gym, right? I'm going to get a Peloton bike and I'm going to cycle on my Peloton bike, yippee-yi-yay, right? But Peloton, leading stock, 52-week highs coming through. Shakeout demand tail onto what moving average? 21-day EMA, undercuts, base lows, undercuts the earnings bar as well, and then it powers higher. Oh, another shakeout demand tail onto what moving average? 21-day EMA. And what are you noticing about the volume on this shakeout demand tail and this shakeout demand tail? There's not much volume. What does that tell you about supply, about selling? There's not that much selling. And then you get the trigger bar over here. Tight inside bar, sitting on the 10, low volume, ride the trend. It's not too complicated. ETH 2021. So why am I showing you crypto as well? Because I want to show you Dow Jones 100 years ago, stocks 1970s, 1980s, 1990s, 2000s, crypto. It's the same. The presence of demand visually displays itself in the same ways. And leading stocks, leading cryptocurrencies, leading whatever act in very similar ways. Because it's, I think, the usual suspects are behind it. Like, they have their methods of execution. Maybe you believe that, maybe you don't believe that. I do wholeheartedly believe that. Shakeout demand tail off the 21 day. Now, given the much more 24/7 nature of crypto, it's much harder to see a gap down reverse bar. So much more commonly, you're going to see shakeout demand tails. So here is effectively a shakeout demand tail, but you could think about it as a bit of a gap down reverse bar off the 21 because of the strength of the recovery as well. And then you get trigger bar. Look how the volume just dries up here. Look at the 52-week highs in the base. So let's just touch upon something, okay? See, on this day here, what's that going to be? The 29th of January, 2021. ETH actually hits a 52-week high on the relative strength line. Think about this, and think about this logically in terms of what I'm going to say. ETH is still in the base on this bar here. It's not broken out. You see that? It's not broken out. Now, it's a bit of a doji. It's got a bit of a supply shoot, a bit of a demand tail, but overall, I'd call this a doji bar. It's not breaking out. It's not taking out the highs of the base, but yet it's hitting a 52-week high. What does that tell you? It tells you ETH is ridiculously strong. One of the strongest signs of strengths that you can possibly see is when a stock or a cryptocurrency or whatever is hitting a 52-week high, and ETH, and when I look at crypto, I like to keep the S&P 500 as the relative strength line on there because it puts the blue dots exactly where I want the blue dots. Basically, it works perfectly for what I'm trying to do with it. But when ETH hits a 52-week high, and this could be a stock as well, if it hits a 52-week high in the base, it's telling you it's extremely strong. So this is a very good sign, certainly if it then tightens up and provides a trigger bar, a gap down reverse bar, shakeout demand tail in coming sessions. Well, the risk makes sense. Remember Doge? I'm old enough to remember Doge. Shakeout demand tail off of what moving average? So even like Momo momentum pumped to the moon by Elon as well, cryptocurrencies, they act in the same way. I just find that fascinating, don't you? Like, they just act in the same way. So here's Doge. Big move here. Look at the volume coming through. Again, demand visually, can you see it? I know my brain like operates very differently, but can you see it? Like, this just sticks out like a sore thumb, right? Visually, can you see the demand, the presence of demand? Look at the volume, look at the 52-week highs, look at the trend here, look at the widespread relative candlesticks. There is a shed ton of demand of buying going on here. And then we're looking for where buying and supply dry up, they dissipate, supply, selling, stops coming to the market, the risk makes sense. Classic games that large operators would play as well. Big shakeout demand tail underneath the 21-day EMA. Oh, what do you notice about the volume? For the size of this shakeout demand tail, the volume's not even above the 30-bar average. Isn't that interesting? What does that tell you about supply? There's not much. And remember, this bar here is designed to shake out weak hands because it didn't look like this bar. At one point in time, it was on the lows here. It was a horrendously wide, bearish looking candlestick. Go back and that like be a B1 or something like that, okay? Really wide, bearish, horrendous looking candlestick. But by the close, it's not that. And this is the point about being able to adapt, having a Bayesian mentality. Adapt. Rate of change in which you can adapt to trading in life. The quicker you can do it, the better you're probably going to be in both aspects. Over here, then you get your trigger bar, inside bar, tight, 10 EMA, low volume. That's what you want to see. Now, also, we can start applying this across multiple time frames. So you ready? We're about to start layering complexity. So I'm just going to show you this one on the 1 hour chart alone, and then we're going to go onto the daily chart and the 1 hour chart as well, side by side, because there's certain things that I look for, and it's about aligning multiple time frames. So this is Roblox here. Now, ridiculously choppy stock was a kind of a social media favorite. I never really understood it as it was a fairly choppy stock, and I've covered in recent videos about the character of the stock. But there's this one instance here during its IPO base, you can go back and look at it, May of 2021, where again, multiple time frames, the presence of demand, it just visually shows itself in a similar manner. Ready? What do you see around the lows of bases? Shakeout demand tail, gap down reversal bar, shakeout demand tail, shakeout demand tail. What chart pattern do you see? Cup and handle, VCP, not a cup and handle, with a shakeout, 2 shakeouts in the handle. So then when you're thinking about, oh, here's a cup and here's a handle, well, what bar marks the low of the cup? Shakeout demand tail. What do you notice about the volume? It's just average. What does that tell you about supply? Don't very much supply coming through. And then you get some bullish synchronicity here. And then in the handle, which will quite commonly look like a Davis box as well, you're looking for shakeouts. Quite often the best handles of a cup and handle will have a good shakeout or two. Gap down reverse bar, shakeout demand tail. Now here's an important concept. You're ready for some complexity and some confusion. Large operators are most active in the first hour of the trading session. So if you see a gap down reverse bar or a shakeout demand tail in the first hour, I give that a lot more weight. Because that there, for me, is, they're up to their usual games. Make sense? You see it across all time frames. Oh, we're going to go on to the daily and the 1 hour on the next slide. I'll show you a couple of stocks I bought as well. So Tesla and also Coinbase. So context. So we started off this presentation with the price cycle, phase 1, phase 2, phase 3, phase 4, okay? So it's, where are you seeing, because the candlesticks will look similar. If you take a look at Tesla here, okay, this bar here that I'm pointing to, and you look at Coinbase here, if you just look at the candlestick in isolation, you don't consider whether it's a gap up or a gap down, you just look at the candlestick in isolation, the candlesticks look pretty darn similar, right? And the volume is pretty similar in terms of being very high versus the 30-bar average. I would say Tesla is about double, Coinbase is just over double, maybe 2.5 times or something like that. So the volume's about the same, the candlestick looks the same as well, but Coinbase is gapping down to the low of a base and a potential support level. It undercuts it. So here we have a gap down reversal bar. So think about Coinbase gapping down to potential support, high relative volume, so we know the bigger boys and girls are active. And what does the candlestick do? Gaps down, opens near the low, recovers. Now, is there a trade to be had there? That's going to be a ridiculously wide stop. But you can see the context here as well. And then you can see over here, this is now more similar to Tesla, that now it's powering out of the base. And actually, when a stock is then being powering out like this, like you can see with Tesla, you then have to be going, okay, institutions love perceived value and liquidity, but they're also looking for liquidity to exit their positions. So after very big rallies like this, be on the lookout for these widespread candlesticks to actually signal the end of the move could be the end of the move might not be far away. So this is why I was talking about thinking lower the bar, lower the bar, lower the bar, lower the bar, if it's extended and climactic looking like a Tesla, like a potential Coinbase here, all waiting for closes below key moving averages. Do you know who sold a shed ton? I think it was about $3 billion worth of stock on this day here. Elon himself, right? Chief exec selling $3 billion worth of stock when it's gone up like this. Well, that's probably the end game, right? Okay, so what we're going to do now is we're going to look at the daily chart and the 1 hour chart as, so this one I bought back in 2021, powered out $1.17 up to nearly $3, like decent move, right, in the space of like 3 days as well. Remember what I said? Lower the bar, lower the bar, lower the bar, lower the bar, lower the bar. It's really effective, okay? But over here, so we got the daily chart and we get this trigger bar on the daily chart. Would it have been even better if it was sitting on the 10-day EMA? Absolutely. It's actually, those of you who know about Oliver Kelp, this is actually a wick play. See how it trades inside the wick that I call a supply shoot of the prior day. Tight inside bar. What do you notice about the volume? Sweet FA in terms of volume. What does that tell you about supply? Very much supply comes to market. Then we take a look intraday, nothingness. Just nothingness. A little bit of bullish ease of movement coming through in here, and then just tap. Look at these trigger bars. And then rips out this here. So this is where we can align multiple time frames to go, okay, trigger bar on the daily chart, wick play if you want to think about that as well. And then when we look at the 1 hour chart and break that bar down, we go, there is very little supply coming to the market on that bar. Tick. Really good. OSTK. This is one here, went on a mega move. This is where I bought it in here. So tight trigger bar, I then messed up the trade management for this, but tightness in price here. Look how the volume dries up as well coming through. And then when I break this bar down here, so we're looking at this trigger bar over here on the daily chart, looking at it on the 1 hour chart. So there'll be 7 bars, okay? So look at this here. Shakeout demand tail, intraday to mark the lows. And what do you notice about the volume? There's not much volume coming through. What does that tell you about supply? Not much supply. So this is how you can deconstruct the bar from a higher time frame onto the lower time frame. This is IONQ. So a couple of quotes here from Livermore as well. Keep your money invested in the leaders of stocks that are moving. The leaders of today may not be the leaders of 2 years from now, even tomorrow, even next week, right? So this is IONQ. So the point I want to make on here, IONQ was, at this moment in time, a very strong stock. Quantum computing, you think about artificial intelligence, you think about pick and shovel type plays to that as well. So the likes of quantum computing, important, right? So this is one here, I was looking at it, but the issue with this one here, and as I've been talking about, the initial stop loss, placing it below the low of this shakeout demand tail. So see how it's sitting there on the 50-day moving average and reclaims the 10 and 21. This bar here is then what we're looking at here. The initial stop loss would have been about 8.5%, around about 8.5%, maybe 9% if you factor in some slippage and getting filled at the limit of say buy stop limit order as well. That was too much risk for me to be taken. So you can get really constructive action in terms of first 1 hour candlestick, shake out demand tail, strong close, and then tight. Hindsight, I could have then placed my stop loss, my initial stop loss maybe here at like 1480 underneath these like intraday area of support. So in this vicinity, I didn't though. But this here, just to illustrate a relatively recent one, constructive price action to see off of the 50, shake out demand tail on the 1 hour chart, tight, volume tries up, not much supply coming to the market. BYSI as well. I did not trade this one, but it's a great example to be showing you. So this stock here, powerful move. Look at the volume coming through. Inside bar sitting on the 10-day EMA, starts building higher lows in the base, and then when you deconstruct what happens in the last 4 days or so onto the 1 hour chart, shake out demand tail, the final session, shake out demand tail. What do you notice about the volume? So now we're looking at this bar in here, this daily inside bar on the 10. Go and look at it on the 1 hour chart. Shake out demand tail. What do you notice about the volume? There's not much volume. What does that tell you about selling? Supply. There's not much supply. And then you get this perfect trigger bar that closes on the high on low volume. Powers out. Nice to see. Affirm. This one I did trade. So this one in here, right? Intraday. So you can see here, actually puts in this inside bar. I had a really funky day the day before, but then this happened. There were a load of stocks that then put in these tight inside bars on the same day Affirm did, and they all basically look like this, which is really constructive price action to see. So here, shake out demand tail and then a trigger bar. So when you then deconstruct that inside bar there on the daily chart and take a look at it, really constructive price action, and it flew out of the game. Fantastic to see. Broadcom as well, so much bigger stock. So when I was then buying it here, I then free rolled it into this bar and then got knocked out of it, break even. But it's building higher lows, starts tightening up in here, shake out demand tail, pulls down intra-session, but pull down like this, volume dries up, and then a nice reversal, and then out it goes there. But again, choppy, hostile markets, I think you got to be pretty darn quick to be free rolling trades. Why you hear me talk a lot about risk mitigation and free rolling trades in these videos. AEHR, so there's another one. Bought it here, and then it reversed very quickly. So I got in here, it then did a U-turn. So that's why active risk mitigation, understanding the free roll levels that I taught you about on GATX. So planning the trade out using that tool as well. I think I've covered that in other videos, certainly cover it in coaching videos on my platform as well, how I plan it all out, the tools that I use as well. But then when you're taking a look at AEHR, prior in the base here, shake out demand tail, and then the final bar here. So this bar here, it's not quite an inside bar, but nearly is. This final bar here, look at the tightness in price. Little side note, little subtlety. On the 1 hour chart, 10, 21 and 50 SMA on the 1 hour chart, I like them when they're in close proximity to each other. So you see here, first 1 hour candlestick, price just trades in the range of that. Tight. Look how the volume just dries up. There's sweet FA in terms of supply coming to market. This is what I want to see. Gatto, here's one I bought. VCP, 1 contraction, 2 contraction, 3 contraction. Took a little while for this one to go, but around the lows of the base. Shake out demand tail. Little shake out demand tail there, not textbook there. But as it started tightening up, shake out demand tail, low volume. It's really nice to see. His MP, one that I bought back in 2022, 1 contraction, 2 contraction, 3 contraction, tight bar, nearly an inside bar, but 10, 21 and 50 SMA on the 1 hour chart, nice and close. Tightness and price, ridiculously good. Look at the shakeout demand tail down there as well. Nvidia, this is one that I bought recently and then it rolled over, but again, free rolled into that before it rolled. Active risk mitigation, really important. So Nvidia, daily chart, shakeout demand tail. Now we're looking at the 15-minute chart. Again, presence of demand will display itself in a similar way across all time frames. Down here, shakeout demand tail, shakeout demand tail, shakeout demand tail. Even better, it's building higher lows, and look how the volume is drying up. What's that telling you about selling pressure? What's that telling you about supply? It's lessening. It's really good, really good to see. So it's not just about daily chart or weekly chart, it's about looking intraday as well. ALGM, shakeout demand tail, gap down reverse bar, absolutely perfectly. Now I know I said I was going to show you guys a little bit of screening, so I will jump across to my stock screen here and I will show you how you can quickly screen for these type of stocks. Okay, we are over on my StockScreenHero. We have free plans and paid plans available. In the free plans, I think there's these preset screens available for you guys at the time of filming, so you can go across and you can test out what I'm going to show you. Just head over to my website, make an account, nice and easy. You can start doing it straight away. I'm going to see if I can do this in under a minute. So we're going to do Indian continuation based screen. I really like these screens. That's why they're in the preset screens as well. So you can do it for Australia, Canada, India, UK, and US as well. So we've got it loaded up here. Now, as I said, I like to not be really strict in terms of the criteria, but filter via relative strength. So I look at the strongest stocks in that specific market first, such as the nature of relative strength. So there is that relative strength 3-month ranking of over 75. You can, if you've got a pay plan, you can create your own screens and do whatever you want to do, right? But what I do here is I scroll across, I double click this relative strength rank 3-month. I want to have the highest stocks coming up first. So here we go. We're going to click this a couple of times and get the 99s to the top. That's what I want to see there. We'll look at 50 results. We'll just do the charts. If you want to do flex charts and see the earnings and sales data, click flex charts. We're just going to do the charts and I'll show you how super duper quick and easy it is to be scanning through. So remember, we're loading 50 per page here, so it can take a couple of seconds to load. The moving average that you see is going to be the 21 day. You can change that via your site settings up here as well. Go to your site settings, change it from candlesticks to bars, change the moving average, whatever you want to do. So now we're looking at the strongest stocks in the Indian market on a 3-month relative strength basis, and I'm looking for those stocks building flags, building VCPs, building cup and handles. Now this stock here has been very strong. Look at this move here, look at the volume, bounce off the 21 as well. So this one here, I want to have that in a watch list. I just literally pin it in a watch list like that. So I'm looking for, see how this stock here got ridiculously tight, inside bar, trigger bar, shakeout demand tail. They are the type of setups that I want to see in whatever market, whatever stocks, whatever cryptocurrencies that I'm looking to trade. This one here, apart industries, shakeout demand tail underneath the 21. Okay, looks like it's going a little bit. I'll just put it in the watch list. It's already in there. They're the kind of ones that I want to be seeing. This one here, Parag Milk Foods. See this one here, shakeout underneath the 21. Looks like it's starting to tighten. So that there, I can then put that into a watch list. I can then go into my watch list over here as well. I can then click view this watches. I can see the charts, the flex charts. I can export these so I can quickly get them into TradingView TT2000, get the data into Excel if I wanted to get the data into Excel as well. So there's free plans, there's paid plans available on the website if you guys are interested in that. Thank you very much for watching the video. Thank you very much for supporting the YouTube channel. I do really appreciate it. Any questions, then just ask me down below. I'll do my best to respond to you personally. Thanks for watching. See you in the next one.